Hello investors and traders. Today we will give an introduction to Gann trading strategy, focusing on cycles, timing, and angles. Before we start giving an introduction, I was very skeptical before I started researching the ideas of Gann. I have a top-down technical analysis system with a weight of evidence to decide on the moves that I will make. I am definitely not an astrological type of avatar, but I do describe and believe in the Stock Trader's Almanac. Stock Trader's Almanac investigates whether traditional season anomalies such as the January effect, monthly effect, January barometer, sell in May and go away phenomenon, holiday effect, etc. I still believe in the Stock Trader's Almanac in these turbulent markets. The evidence indicates that there is still values in these anomalies. So after the initial complete disbelief in Gann, I said, let's take a look and find value, since I find great value in tracking events. Remember, astrology was only a part of the toolbox of Gann. Geometry and trigonometry were others. But no one indicator or strategy will make a system, but many indicators and strategies will make you a successful trader or investor. There is no black box newsletter or magic Harry Potter wand, but hard work and weight of evidence approach will help you achieve your goals. I'm calling this an introduction to Gann because of the ideas worked in this video. I will further dwell into Gann strategies. It is also an introduction because each one of these three parts, Gann cycles, timing, and angles, should have their own video. W.D. Gann is remembered for using geometry, astrology, and ancient mathematics to predict events in the financial markets. He developed the technical analysis methods of Gann Angles indicator and master charts. Gann is the author of How to Make Profits Trading in Commodities and 45 Years in Wall Street. W.D. Gann died on June 18, 1955. Key takeaways. W.D. Gann created trading strategy using geometry, astrology, and ancient mathematics. His technique, known as Gann indicators, are used in predicting the top, bottom, and future price moves of commodities. These not only commodities it works in, but in securities and other types of assets. Early life and education. W.D. Gann was born on June 6, 1878 in Lufkin, Texas. With limited education, Gann was a self-taught investor who began trading in the early 1900s. In 1908, he moved to New York City to open his brokerage firm, W.D. Gann and Company. Publications. In 1919, W.D. Gann began publishing the daily market letter, the Supply and Demand newsletter, which reported on stocks and commodities and made yearly forecasts. Gann's second publication in 1923, the Busy Man Service, provided detailed trading recommendations. Understanding Gann indicators. Gann indicators are based on the notion that markets rotate from angle to angle, and when an angle is broken, the price moves towards the next one. Gann time cycles will help to forecast the future of the market. Let's start with forecasting daily moves. The daily movement gives the first minor change and conforms to the rules. In fast market, there will be a 2-day move in the opposite direction to the main trend, and on the third day, the upward or downward course will be resumed in harmony with the main trend. The market goes upwards or downwards or straight. What Gann is saying is that, let's say we are in a bull market, and then we have a correction. This correction in fast markets will last 2 days, and going into the third day, it will reverse on you. So it's all based on the notion of threes. Next, a daily movement may reverse the trend and only run 7 to 10 days, then follow the main trend again. During a month, natural changes in trends occur around the 6th to the 7th, 14th to 15th, 23rd to 24th, 9th to 10th, 19th to 20th, and 29th to 31st. Those minor moves occur in accordance with tops and bottoms of stocks. It is very important to watch for a change in trend 30 days from the last top or bottom, then watch for changes 60, 90, 100 days from tops to bottoms. 180 days or 6 months, very important, and sometimes market changes for greater moves. Also around the 270th to the 330th day from the important tops or bottoms, you should watch for the important minor and often major changes. January 2nd to the 7th and the 15th to 21st. Watch these periods each year and note the highs and low prices made. Until these high prices are crossed or low prices broke, consider the trend up or down. Many times when stocks make low in the early part of January, this low will not be broken until the following July or August, or sometimes not during the entire year. This same rule applies in bear markets or when the market trend is down. High prices made in early part of January are often high for the entire year and are not crossed until after July or August. Casting weekly moves. The weekly movement gives the next important minor change in trend, which may turn out to be a major change in trend. In a bull market, a stock will often run down 2 to 3 weeks and possibly 4, then reverse and follow the main trend again. As a rule, the trend will turn up in the middle of the third week and close higher at the end of the third week, the stock only moving 3 weeks against the main trend. In some cases, the change in trend will not occur until the fourth week. Then the reversal will come and the stock close at the end of the fourth week. Now we are taking the ideas of the daily change and bringing over to the weekly change and saying the rule is very important of 3. So let's say in a bull market, we are going up. We will go up 2 or 3 weeks, and the fourth week we will reverse. And then we will go up 2 or 3 weeks, and the fourth week will reverse. No market goes up, no market goes down. Reverse this rule in a bear market. In rapid markets with big volume, a move will often run 6 to 7 weeks before a minor reverse a trend. And in some cases, like 1929, these fast moves like 13 to 15 weeks or 1/4 of the year. These are culminations of moves ups or down. As there are 7 days in a week and 7 times equals 49 days or 7 weeks, this often marks an important turning point. Therefore, you should watch the top or bottom around the 49 to 52nd day, although at time of change will start on the 2nd to the 45th day because period of 45 days is 1/8 of the year. Also watch for a culmination at the end of 90 to 98 days. After a market has declined 7 weeks, it may have a 2 or 3 short weeks on the side and then turn up, which agrees with the monthly rule for the change in the third month. Always watch the annual trend of the stock and consider whether it is in a bull or bear year. In a bull year, within the monthly chart showing up, there are many times that a stock will react 2 or 3 weeks, then the rest 3 or 4 weeks, and then go into the new territory and advance 6 to 7 weeks more. How many times in a bear market we've seen where we went down straight 3, 4, 5 weeks, and then we had a 1 to 3 week bear market rally and then continued lower. So it's very important to figure out if we are in a bull or bear market. After a stock makes the top and reacts to 2 or 3 weeks, it may then have a rally to 2 or 3 weeks without getting above the first top, then hold in a trading range for several weeks without crossing the highest top or breaking the lowest week of the range. In most cases, this kind you can buy near the low point or sell near the high points of the range and protect with a stop loss order 1 to 3 points away. However, a better plan would be to wait until the stock shows a definite trend before buying or selling. Then buy the stock when it crosses the highest point or sell when it breaks the lowest point of the trading range. Rules for future cycles. So we went over day, weekly, and now we're going to start looking over for future cycles. Stocks move in a 10-year cycle, which are worked out in 5-year cycles, a 5-year cycle up and a 5-year cycle down. Begin with extreme tops and extreme bottoms to figure all cyclical, either major or minor. Rule 1. A bull campaign generally runs 5 years, 2 years up, 1 year down, and 2 years up. completing a 5-year cycle. The end of a 5-year campaign comes in the 59th or 60th month. Always watch for the change in the 59th month. Rule 2. A bear cycle often runs 5 years down. The first moves 2 years down, then 1 year up, and 2 years down, completing the 5-year downswing. Rule 3. Bull or bear campaigns seldom run more than 3 to 3.5 years up or down without a move of 3 to 6 months or 1 year in the opposite direction, except at the end of major cycles, like 1869 and 1929. Many campaigns culminate in the 23rd month, not running out of the full 2 years. Watch the weekly and monthly charts to determine whether the culmination will occur in the 23rd, 24th, 27th, or 30th month of the move, or in extreme campaigns in the 34th, 35th, or 41st to 42nd month. Rule 4. Adding 10 years to any top, it will give you a top of the next 10-year cycle, repeating about the same average fluctuations. Rule 5. Adding 10 years to any bottom, it will give you the bottom of the next 10-year cycle, repeating the same kind of year and about the same average fluctuations. Rule 6. Bear campaigns often run out in 7-year cycles or 3 years or 4 years from any complete bottom. From any complete bottom of a cycle, first add 3 years to get the next bottom, then add 4 years to the bottom to get the bottom of a 7-year cycle. For example, 1914 bottom, add 3 years, give 1917 low of panic, then add 4 years to 1917 gives 1921 low of another depression. Rule 7. To find any major or minor top, add 3 years to get to the next level, and add 3 years to the top, which will give you the third top. Add 4 years to the third top to get to the final top of a 10-year cycle. Sometimes changes in a trend from any top occurs before the end of a regular time period. Therefore, you should begin watch the 27th, 34th, and 42nd months of reversal. Rule 8. Adding 5 years to any top, it will give you the next bottom of a 5-year cycle. In order to get to the top of the next 5-year cycle, add 5 years to the bottom. For example, 1917 was the bottom of a big bear campaign. Add 5 years gives 1922, top of a minor bull market. Why do I say top of a minor bull campaign? Because the major bull campaign was due to the end in 1929. 1919 was top. Adding 5 years to 1919 gives 1924 as the bottom of a 5-year bear cycle. Refer to rules 1 and 2, which tell you a bull or bear campaign seldom runs more than 2 to 3 years in the same direction. The bear campaign from 1919 was 2 years down, 1920 and 1921. Therefore, we only expect that the 1-year rally in 1922, then 2 years down, 1923 and 1924, which completes the 5-year bear cycle. Looking back to 1913 and 1914, you will see the 1923 and 1924 must be bear years to complete the 10-year cycle from the bottoms of 1913 to 14. Then note only 1917 bottom of a bear year, adding 7 years gives 1924 also as a bottom of a bear cycle. Then adding 5 years to 1924 gives 1929 top of the cycle. It's all looking at the years. 3 years, 5 years, 8 years, and know that even in a bull market, we will have 1 or 2 years down. Even in a bear market, we will have 1 to 3 years down. Gann angles. What are Gann angles? Gann angles are named after their creator, W.D. Gann. Gann believed that angles could predict the future price movements based on geometric angles of time versus price. Gann was the 20th century market theorist. The validity and usefulness of the theories, however, are subject to debate. Gann angles has little or nothing to do with astrology. Several Gann angles used today make up the Gann fan. Key takeaways. Gann angles are based on the 45th degree angle known as the 1-1 Gann angle. Believe the 45-degree angle is important, and trends above it are strong and trends below it weaker. Gann angles are applied from the price bottom extending upwards or from the price bottom extending downwards. Other Gann angles include 2 to 1, 3 to 1, 4 to 1, 8 to 1, 1 to 2, 1 to 3, 1 to 4, 1 to 8. The theory is that the price moves through one angle, it will gravitate towards the next. W.D. Gann designed several unique techniques from studying price channel charts. Central to Gann's techniques was geometric angles in conjunction with the time and price. Gann believed that specific geometric patterns and angles had unique characteristics that could be used to predict price action. All of Gann's techniques require the equal time and price intervals to be used on the charts, so that rise run of 1 to 1 will always equal a 45-degree angle. Gann believed that the ideal balanced time and price exists when the price or fall at 45-degree angle relatively to time axis. This is also called a one-on-one angle. Prices rise, one price unit for each time. Gann angles are drawn between a significant bottom and top or vice versa at various angles. Deemed the most important, Gann, the one-on-one trend line signifies a bull market if prices are above the trend line or bear market if below. Gann felt that one-on-one trend line provides major support during an uptrend, and when the trend line is broken, it signifies a major reversal in the trend. Gann identified 9 significant angles, with the one-on-one being the most important. 1 times 8, 82.5 degrees. 1 times 4, 75 degrees. 1 times 3, 71.25 degrees. 1 times 2, 63.75 degrees. 1.1, 45 degrees. 2 times 1, 26.25 degrees. 3 times 1, 18.75 degrees. 4 times 1, 15 degrees. 8 times 1, 7.5 degrees. Note in the order for the rise run values, example 1 times 1, 1 times 8, etc., to match the actual angles in degrees. The x and y axis must have equally spaced intervals. This means that one unit of an x-axis, hour, day, week, month, etc., must be the same distance of one unit of the y-axis. The easiest way to calibrate the chart is to make sure that the 1 by 1 angle produces a 45-degree angle. Observe that each of the angles can provide support and resistance depending on the trend. For example, during an uptrend, the one-on-one angle tends to provide a major support. A major reversal is signaled when prices fall below the 1 to 1 angle trend line. According to Gann, prices should then be expected to fall to the next trend line, the 2 times 1 angle. In other words, as one angle is penetrated, expect prices to move and consolidate at the next angle. Gann developed several techniques from studying market actions. These include Gann angles, Gann fans, Gann grids, and cardinal squares. A Gann fan displays lines at each of the angles that Gann identified. You can see the S&P 500 bounce off the one-on-one and 2 times 1 lines. The next chart, the same S&P data with the Gann grid. This is an 80 by 20 grid. Each line of the grid is 1 by 1 and the lines are spaced 80 weeks apart. Several angles together make up the Gann fan. Gann studies have been used by active traders for decades, and even though the futures and stock markets have changed considerably, they remain a popular method of analyzing an asset's direction. Newer trading areas such as foreign exchange markets and invention of exchange-traded funds (ETFs) have made it necessary to revisit some of the construction rules and application concepts. Although the basic construction of a Gann angle remains the same, this video article will explain why the changes in price levels and volatility have made it necessary to adjust key components. Gann angles are popular analysis and trading tool that are used to measure key elements such as pattern, price, and time. The often debated topic of discussion among technical analysis is the past, the present, and the future all exist at the same time on a Gann angle. When analyzing and trading a particular market, the analyst or trader tries to get an idea where the market has been, where it's about to former bottom or top, and how to use the information to forecast future price action. Difficult information to consume, and if you made it 19 minutes so far, you are doing a great job. These are important ways to look at the market, and this is not easy stuff, even to consume this information. Gann strategies are very difficult and will take many videos and many hours of studying it to put it inside your system. Time, the strongest market influence. According to Gann, time has the strongest influence on the market because when the time is up, the trend changes. Concerning importance of Gann's assigned to time factor, consider the following. Gann quote in reference to his analysis of the October eggs futures contracts. The greatest time period from January 24th to February 8th was 11 market days, and the last advance from April 18 was 11 market days. Therefore, when the market declines more than 11 days, it will overbalance the greatest time period. When it declines more than 75 points, it will overbalance the last price decline or space reversal and indicate lower prices. Notice that Gann used the term overbalance of time. This was a common expression of Gann in his market writings and forms of an integral part of the theory of technical analysis. Overbalance occurs when a move in price and time overextends and travels too far in one direction. When this happens, the market can be expected to react in the opposite direction with the same force, magnitude, including the time factor. This confers a certain amount of predictability in the movements of prices once the concept has been mastered. Combining time and prices forms the basis for such a Gann theory. Author John Murray, in the Technical Analysis of the Future Markets, wrote, Gann saw a definite proportional relation between the two. One of his methods for finding tops or bottoms is based on the squaring price and time. That is, when a unit of price equals a unit of time. For example, Gann would take a prominent high in the market, convert that dollar figure into calendar unit, days, weeks, and months or years, and project the time period forward. When the time period is reached, time and price is squared, and a market turn due. As an illustration, if the market hit a prominent high at 100, Gann counted 100 days, weeks, months, or years forward. Those futures identify possible turning points. The timing tools Gann used is a concept he referred to as anniversary days. This term refers to the historical dates the market made major tops and bottoms. The information collected in the effect reflects the seasonality of the market because often an anniversary date repeats in the future. A cluster of anniversary dates indicates a strong tendency of market to post a major top and bottom of each year at the same time. The dates and time spans between the anniversary dates, top to top, top to bottom, bottom to bottom, and bottom to top, were fundamental factors in his thinking, and these relationships further led to his development of the theories of time cycles in his quest to accurately forecast price movements in the market. In his book, Pattern Price Time, James A. Hersowitz wrote concerning Gann's time cycle studies. When looking at anniversary dates, he saw a series of one-year cycles. In geometric terms, the one-year cycle represents a circle or 360 degrees. Building on geometric relationships on the market, Gann also considered the quarterly divisions of the year to important timing periods. These quarterly divisions are 90-day cycles, the 100-day cycle, and the 270-day cycle. In using one-year cycle and the division of this cycle, you will find the date where a number of these cycles line up, preferably 3 or more, in a single point in time in the future. A date where the number of cycles lined up is called a time cluster. The time cluster used to predict major tops and bottoms. Time clusters are a major part of Gann analysis and should be combined with price indicators to develop a valid market forecast. Importance of number 3. Majority of moves will generally occur in time periods of 3 days, weeks, or months. Never trade in the direction of the trend on its third day. I think his discoveries are at least worth taking a look. The problems that he faced was that he was afraid to let on what he was using as one of his tools to predict market cycles. That was astrology. It was only part of his tool. Geometry and trigonometry were others. I was very skeptical when someone speaks about astrology to predict the market. But as I told you at the beginning of the video, I'm a big fan of Stock Trader's Almanac. And Stock Trader's Almanac looks back at the Christmas rally or certain other effects and it puts it into time value. So he is doing the same thing, only using astrology. Astrology was one of the things he used, but geometry and trigonometry were other ways that he used for his trading system. I recently talked to a person who was teaching some of the very interesting marking geometry things. I once commented about Gann. His reply, Gann was an embarrassment to trading because of his astrology. I was taken aback by that attitude. Now, I'm not into astrology, but I do know a few things that could give support to it. We know the moon has effect on the earth and to the people. We know the sun affects our daily seasonal cycle. We know that gravity has a huge effect on us since the sun's gravity affects us all, the planets we begin, and the whole solar system fabric must be tugged any which way by the positions, planets, just as the moon causes the tides to the ocean. The bottom line, gain strategies can help you gauge the overall health of the market or an industry, but it shouldn't be the only one metric you should consider. Before starting to study gain, I saw the importance of three, even the way I speak. When I explain myself, I speak in threes. Major companies and brands always, when they try to explain things, speak in threes. There are other factors that show Gain's theories are not too out of this world. We follow a lot of these moves where the market goes up 3 weeks and then pulls back 1 week in a bull or bear market. So again, these theories are not out of this world and should definitely to be looked on. Gain theory works in a variety of markets. I do think it is a powerful indicator, but it cannot be used as a standalone indicator, but coupled with other indicators, use a weight of evidence. One indicator does not make a successful system. Please watch the other videos, MACD, RSI, top-down analysis, to combine these indicators to make a rule-based strategy. There are many interpretations of how to use the Gain strategies, and it will take you more than just this video of 26 minutes, 27 minutes to truly understand the Gain. It may take you 3 to 6 months, but we are going to put in some basic principles into our weight of evidence of over 100 indicators, especially the importance of three, how many weeks it pulls back, seasonality, and we'll also be looking in the year 2023 how the first 2 weeks are going. Many trading systems and software programs are based on the Gain system. Many people try to sell you a newsletter. I believe it's just better learning the Gain system and slowly putting some of the Gain principles inside a weight of evidence of how you looked on it. I do not believe the Gain indicators can be used as just one indicator and to believe it. But the Gain strategies, the Gann angles, the Gain timing, the Gain cycles, we should study it, analyze it, adapt it. Peace.